Common advice is high earners should stick with traditional 401ks while lower earners should go Roth. But in many cases, the math tells a different story. And in this video, I'm going to break down why. The decision really comes down to one thing: the taxes you'll pay now versus the taxes you'll pay later. And taxes come in all shapes and sizes. Here's the surprising part. Today's tax rates are near historic lows, which changes the math a little bit. We'll take a look at how that calculation works in a second. But taxes are just a start. You'll also need to consider how RMDs, or required minimum distributions, can trap you later, how Roth can help you avoid Medicare surcharges, and why Roth dollars are often the better asset to leave to your kids. But first, let's set the stage. With a traditional 401k or IRA, you get a deduction today, but you pay taxes later on when you withdraw it. In the eyes of the IRS, it's as if you didn't make that money today at all, and it doesn't affect your tax brackets today. With a Roth 401k or Roth IRA, you pay the taxes now, but the growth and your withdrawals are tax-free later on. So the real question is, which tax rate's going to be lower for you, today's or tomorrow's? That's what we're here to figure out. All right, let's start where tax rates are today. Right now, the top federal tax rate is 37%, but go back in history, and in the 1970s, the tax rate was almost 70% was the top marginal tax rate. Go back to the 50s, it was over 90%. So now these are the top federal tax brackets going back in history, of course, inflation adjusted. But if we were to look at these income levels, so this is 100,000, 200,000, and 300,000, even looking at these income levels today, the tax rates are at historic lows. Going back to the 1980s, they reached 45%, and then they've declined since then. So they're at historic lows today. And those lows are rates that haven't been seen in 70 years. So compared to history, we're living in one of the lowest tax environments the US has ever had. That's why many argue that Roth is a no-brainer. You pay the tax now, you lock in the low rate, and you never have to worry about taxes in the future. This is actually counter to the more traditional advice, assuming that you're going to be in a lower tax bracket in retirement. So you should opt for traditional today. Of course, nobody has a crystal ball, but if you think Congress will eventually raise taxes in the future to deal with debt and spending, Roth starts to look like a better long-term bet. The question is, are you willing to bet that tax rates will stay this low for the next 20 to 30 years? Now let's talk about marginal rate arbitrage, which is just a fancy way of saying comparing your tax rate today to your expected tax rate later on. If you're at a 37% tax bracket now, and you think you'll be in a much lower bracket in retirement, traditional contributions might make sense. You save at a higher rate today, and you pay back at a lower rate later on. But if you're in a moderate bracket now, say 22% or 24%, and you think retirement income plus RMDs plus potentially a pension could push you into a higher bracket later on, Roth contributions give you an advantage. Here's what I want you to do. I want you to line up your numbers, and we're going to take a look at this sample client later on when we talk about required minimum distributions. But for now, what's your marginal tax rate today? How much income will you need in retirement? And where will it come from? Social Security, pension, investment accounts, required minimum distributions? The key is, don't just follow blanket advice. Look at your personal situation, your income trajectory, and your likely bracket and effective tax rate in retirement. This is what we do when we help somebody plan for their retirement. We're not just pulling advice out of a textbook. It all comes down to each and every individual and family situation and what's right for them, which is exactly what you should do. Or you could call us and we'll do it for you. If you're not sure about any of this, grab your last tax return and call a fiduciary advisor who can walk you through it. Now let's talk about required minimum distributions, or RMDs, because this is where a lot of people get blindsided. If you have money in a traditional IRA or 401k, the IRS doesn't let you keep that money growing tax deferred forever. Starting at age 73 or 75, depending on when you were born, you're required to begin taking withdrawals, whether you need the money or not. Here's the problem. Those withdrawals are treated as ordinary income. So even if you don't need the money to live on, it stacks right on top of your Social Security, it stacks on top of your pension and any other income that you might have. That can push you into a higher tax bracket, trigger higher Medicare premiums, those IRMAA surcharges that we're going to cover in a bit, and limit your flexibility in retirement. Let's say you have $2 million in a traditional IRA at age 73. Your first required minimum distribution is going to be around $75,000. Layer that on top of Social Security and maybe a pension, and you could easily find yourself in a higher tax bracket than you expected. Now contrast that with Roth accounts. Roth IRAs have no RMDs during your lifetime. That means that you're in complete control of when or if you touch those dollars. Let's bump up those balances for a second and see what happens if someone has even more money in a traditional 401k or IRA. So this individual has $3.5 million in an IRA. And when they reach age of required minimum distributions, their RMDs are going to be $140,000 a year. Now, this is interesting because this shows what their goals are. This orange line shows what they need to hit their goals. And when they reach the age of required minimum distributions, their Social Security plus their pension plus their required minimum distributions are pushing them over what they actually need to live in retirement. So in this example, they have $100,000 more of income than they actually need. So what that means is that they're going to end up paying more taxes than they should because they don't need all that money to live. Now here we're looking at the different tax brackets. So here we have a 12% tax bracket, 22% tax bracket, and 24% tax bracket. And you can see a large portion of that required minimum distribution fills their 22% tax bracket, where they didn't need to take all that income in retirement. Now let's compare that to somebody that has $2.5 million in a Roth and $1 million in a traditional IRA. So here you can see when they reach the age of 73, their required minimum distributions are much lower. So $42,000 compared to the $138,000 from the prior example. And when we look at their goals, they're not getting forced income or required minimum distributions over and above what they actually need to live. So their RMDs plus their pension plus their Social Security makes up their goals. What that also means, if we want to take a look at their tax brackets, is that they're not going to be paying as much taxes. So here, these are the same tax brackets that we were looking at before, 12% and 22%. And this individual who has the majority of their money in Roth, so $2.5 million in Roth and $1 million in a traditional 401k, are barely going into the 22% tax bracket. So most of their income is filling the 12% tax bracket. And that's where planning ahead really matters. If you're heavily weighted toward traditional accounts, your future RMDs could end up dictating your tax bill in retirement instead of you dictating it yourself. So when we talk about Roth versus traditional, it's not just about your tax rate today, it's also about avoiding potentially getting handcuffed by RMDs later on. Next up, let's talk about Medicare surcharges, also known as IRMAA, or Income Related Monthly Adjustment Amount. This is a little known tax. If you don't know about it, you're about to learn, and it's got this whole new set of tax brackets that you have to be on the lookout for in retirement. This is the surcharge you pay on your Medicare premiums if your income goes above a certain threshold. And here's the catch. Withdrawals from your traditional accounts do count toward that income, whereas withdrawals from your Roth don't. Let's say you need an additional $50,000 in a given year, and all you have is traditional IRAs. Well, if you pull that money out of your IRA, it's going to raise your modified adjusted gross income. And if you found yourself in this bracket before, well, you might find yourself in this bracket later on. And these brackets are like cliffs. They don't charge you a certain amount at each level. If your income falls into that bracket, you get hit with the whole additional premium. And here it's $185 on your Medicare Part B and an additional $35 a month on your Medicare Part D. And if you're married filing jointly and both spouses are on Medicare, this number gets doubled. So that could be an additional $5,000 a year on your Medicare premiums. Multiply that by 20 years, that's an additional $100,000 that you might have to pay just because you had money in a traditional IRA over a Roth. If that same $50,000 comes from a Roth, your Medicare premiums don't change at all. That flexibility can save you thousands over time. The IRMAA thresholds aren't that high either. For 2026, they start around $212,000 for married filing jointly, and for single filers, it'll be about half that. The numbers haven't been adjusted for 2026 yet, but the income it will be based on is based on your 2024 tax return because there's a 2-year look back. If you're pulling money from traditional IRAs on top of Social Security and other income, you can hit those thresholds faster than you think. With Roth withdrawals, You get the money you need without affecting your Medicare costs. That's real money staying in your pocket instead of going to higher premiums. Finally, let's talk about inheritance. Under the Secure Act, most non-spouse heirs have to empty their inherited retirement accounts within 10 years. That's a big change from the old rules where they could stretch distributions out over their lifetime. If you leave a traditional IRA or 401k to your heirs, they have to take that money out as taxable income, often during their highest earning years. That could push them into an even higher tax bracket and create a real tax burden for them. So when you're looking at taxes today versus taxes tomorrow, this puts a different spin on things. But if you leave a Roth account, it's tax-free. They still have to pull the money out within 10 years, but they won't get hammered by taxes when they pull that money out. Think about it. Your kids are probably in their peak earning years when they inherit the money from you. The last thing that they need is a big tax bill on top of their regular income. On top of that, each child might be in a different tax bracket. So when they're done paying the taxes, they may be left with an uneven inheritance. In this chart that you can see a sample set of children that each inherit a third of an IRA. Even with assets growing at a moderate 5% over the 10-year period and liquidated on the 10th year, they still get a wildly different number after tax. If it's a Roth IRA that they're inheriting with the same 5% growth over those 10 years, those numbers can look wildly different and the inheritance a lot more attractive. From a legacy standpoint, Roth is arguably the better asset to pass down. It's cleaner, it's tax-free, and it puts more money in your family's pocket instead of the IRS. So let's bring this all together. Historically, tax rates are low, which supports Roth, but marginal rate arbitrage means that you have to compare your rate now with your rate later, and that's personal to your situation. Also, RMDs can trap you in higher tax brackets and limit your flexibility, which gives another point to Roth since it gives you more control over your retirement income and helps you avoid Medicare surcharges. And from an inheritance perspective, Roth is arguably the better asset to pass down. The truth is, there's no one-size-fits-all answer. For many people, Roth has the momentum, but for some high earners in top tax brackets today, traditional 401ks and IRAs still have a role. That's why the smartest strategy isn't just picking one, because you don't have to. It's using a balance. Having both Roth and traditional dollars gives you the flexibility to manage your taxes throughout retirement. Here's your action step. If you're not sure which way to go, grab your tax return and run the numbers. Or better yet, call a fiduciary advisor who can help you map out your specific situation. Getting this right means staying in charge of your money, not the IRS. And in retirement, that control and flexibility matter more than almost anything else. Now, speaking of flexibility and making adjustments, if you've already claimed Social Security and you're wondering if you made the right choice, I've got some good news for you. There are still moves that you can make even after you started benefits. I cover all that in a video called Claim Social Security Early. Here's what to do. You can click on it right here and watch next. Thanks for watching today, and I'll see you on the next one.